Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So I want to talk about the bond market. Now, have you been noticing since October of last year, November of last year, we've seen the bond market, the yields, kind of trade sideways. Of course, it had a little bit of spikes up and of course a spike down, especially during March of this year when we had the regional bank issues. We had panic in the bond market. But then afterwards, those yields creep back up to the highs of March, and it's kind of just flatlining there, right? And you're seeing kind of a difficulty for bond yields to break out higher throughout the whole curve. Although yes, the 30-year lately has been selling off more aggressively than the short end. You're seeing the 30-year yields push up a little bit higher than the 2-year, and it's causing a little bit of a steepening in the curve, but not so aggressively or so much like we've seen in 2022, where yields were completely skyrocketing and bond prices were selling off. So if you just look at from October of last year till now, and just expand the chart, look at it on a daily, weekly, or monthly, it's just been kind of in a range here. And why I bring this up and why this is important is because the bond market here is signaling for about a year, because we're almost to October, right? So it's almost been a year where bond market's been saying that, you know what, the Fed is probably already done. And the bond yields have been basically in pause mode way ahead than the Fed, because they're probably again signaling that we're probably going to get a pause from the Fed, because demand and growth is deteriorating. You're seeing also outside of the US where China is having a very big problem in their economy with the real estate and so on. And people are feeling the pinch with the higher inflation, higher rates. Now, with oil prices moving up higher, and with inflation, yes, coming down, but not to the 2% target, it would make you think that shouldn't yields be moving up higher? And didn't we hear from a lot of prominent, amazing hedge fund traders out there come out and say that we could see yields even go up to 5.5% in the 30-year? That hasn't happened yet. In fact, we've just been seeing more of the sideways action. And that sideways action is very telling, because it's telling us that, hey, the bond market is expecting that the Fed is done with higher rates. We're done here. We can't see higher rates going forward. And in fact, what happens next after higher rates? You start to see the rate cuts. And yes, you are getting the markets projecting that next year we're going to see rate cuts sometime in the summer. So if bond yields have been trading sideways here, then where can bond yields go going forward? Where can they go? They can only go one place, especially if the Fed comes out and signals a pause, and that is down. We would expect that the next monetary policy adjustment would be lower rates, which would cause those yields to come down and bond prices to move up. So in fact, in 2024, we could see bonds being one of the assets there that outperform and do better than maybe other assets, like maybe better than stocks, right? Or maybe not, but definitely if you compare 2022 versus, let's say, maybe next year, 2022, we saw bonds do horrible. And we've never seen this kind of massive aggressive tightening since 1980s. And if we are to reverse everything in terms of the rate hikes and the monetary policy, then of course we should see very good returns in the bond market. Now, this is not financial advice. Please don't take this as financial advice. I'm not a financial advisor. Always consult with a registered financial advisor before making any investing and trading decisions. So do not take this as financial advice. I'm just spotting out that, hey, look, the yield's been trading sideways and there's only one way we could see it go. that is probably lower. And if it were to go higher, that would probably mean that, hey, that means inflation is getting way worse than expected. That means that oil prices might be not at $100, maybe $130, maybe even higher than that. Food prices go up. Maybe there's a war. There's many other risks and factors that could cause yields to then spike up. But if the bond market, which is traded by smart money and institutions, have been trading sideways, those yields for some time, I think they're signaling here that, we could see a reversal in those yields, some sort of change in the monetary policy, and they're waiting. They're waiting to hear from the Fed to confirm that. And if the Fed confirms that, yes, they're in pause mode, then sure, you can see that reversal in those yields. Now, another thing you want to notice is back in 2008, right, when the crash happened, and actually before that, bond yields from 2006 to 2007 for 1 year straight were also trading sideways. And then what happened after that sideways trading, right? Bonds were basically signaling that, hey, the Fed is probably done hiking rates, and therefore we're going to see some sort of change in the policy, in monetary policy, in rate hikes. And that's why you saw the bond yields kind of trading sideways. And then what happened after 2007, right? 2008 came, and we started to see the Fed start to ease up on rates. And lo and behold, another year after, in September 2008, that's when we saw the big crash in the equity markets. But as that was approaching, you had the bond market, those yields start to come down and those prices to go up. So it makes me think and wonder, could we see the same thing like 2006, 2007, the same setup here, where October of 2022, we've been trading sideways, and it's now 2023. We're approaching October 2023. So that's your 1 year. And then maybe there might be a signal this year or the start of next year of the definite pause. And that's when you start to see those bond prices move up and those yields kind of ease. Just like 2006, 2007, and then you had the 2008 where that big unwinding of lower rates and caused bonds to skyrocket. Bonds were a great asset to buy. Could we see the same thing where 2024 bonds end up being an amazing asset as these yields, as these traders start to expect that this pause is going to lead to rate cuts, and rate cuts, as we know, will bring lower yields and cause bond prices to move up. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.